The natural goal of trading is profit. Almost everyone who enters the financial markets does so with the expectation of making money. The idea of financial independence, flexible working hours, and the possibility of turning a relatively small amount of capital into meaningful returns makes trading extremely attractive. For many beginners, trading appears to be a direct path to financial improvement. Charts move, prices fluctuate, and every movement seems like an opportunity to capture profit. This simple observation often shapes the early mindset of new traders. The focus becomes clear and direct: enter the market, make money, and repeat the process as frequently as possible. This expectation, however, quietly shapes early trading behavior in ways that are not always productive. When profit becomes the central focus, attention naturally shifts toward outcomes instead of decisions. Instead of concentrating on whether a trade follows a well-defined setup, the mind begins to prioritize how much money a trade could make. The chart stops being a place of analysis and becomes a place of anticipation. Every movement feels meaningful, and every potential trade begins to look like an opportunity that should not be missed. In this stage, intention and execution begin to separate. The intention might be to trade with discipline and patience, but the execution often becomes impulsive and reactive. As trading activity continues, the pressure created by financial expectations gradually increases. At first, the pressure may be subtle. A trader may simply want to see the account grow quickly as proof that trading works. Over time, that desire can evolve into urgency. When someone expects fast financial progress, every trade begins to carry emotional weight. A winning trade feels like validation, while a losing trade feels like a step backward, not only financially but psychologically as well. This emotional connection to results introduces performance anxiety. Markets move quickly, prices change within seconds, and the fear of missing profitable opportunities starts influencing decisions. Urgency is one of the most powerful psychological forces in trading. When the mind believes that opportunities are constantly slipping away, patience becomes difficult. Instead of calmly waiting for a clear setup, the temptation grows to enter trades early or without confirmation. The reasoning appears logical in the moment. Entering slightly earlier might capture a larger portion of the move. However, this subtle shift marks an important turning point. Strategic thinking begins to weaken, and emotional reactions start guiding behavior. Decisions become faster but less structured. Trades are placed based on anticipation rather than confirmation, and the original trading plan begins to fade into the background. This is often the moment when discipline quietly starts breaking down. Trading rules that once seemed essential begin to feel restrictive. Waiting for confirmation may appear too slow, especially when the market is moving quickly. As a result, entries begin to happen earlier than planned or without full alignment with the original strategy. At the same time, position sizes may start increasing. The reasoning behind this change is usually connected to the desire to accelerate profits. If a small position generates a small gain, increasing the size seems like a logical way to reach financial goals faster. In reality, this change increases emotional exposure to market fluctuations. Once rules begin to loosen, consistency becomes difficult to maintain. Some trades may work purely by chance, reinforcing the belief that the new behavior is acceptable. A trade entered without confirmation might still produce a profit, and that success can make the deviation from rules appear justified. However, randomness gradually replaces structure. Instead of following a repeatable process, trading becomes a sequence of unpredictable decisions influenced by moment-to-moment emotions. Over time, this environment gives rise to emotional trading cycles. After a small series of winning trades, confidence can quickly transform into greed. The mind begins to expect that the next trade will also be successful, which encourages larger positions and faster entries. The market may continue rewarding this behavior temporarily, but eventually a losing trade appears. When losses occur after a period of optimism, fear becomes the dominant emotion. Traders may hesitate to take the next valid setup or close positions prematurely to avoid additional losses. If several losses occur close together, another emotional reaction often emerges: the desire to recover quickly. This is commonly known as revenge trading. Instead of calmly evaluating the next opportunity, the mind becomes focused on regaining what was lost. Trades are placed more aggressively, often during moments of high market volatility. These entries are rarely based on a clear strategy. Instead, they are driven by the hope that a single trade will repair the emotional discomfort caused by previous losses. Unfortunately, this behavior typically leads to further inconsistency. Volatile market conditions intensify these emotional patterns. Rapid price movements create the illusion that profits are constantly within reach. This environment encourages impulsive entries because the market appears to move without waiting. In reality, volatility increases uncertainty, which makes disciplined decision-making even more important. However, when emotions dominate, the focus shifts away from structure and toward immediate results. The central insight behind these patterns is simple, but often overlooked. The more attention traders place on money itself, the less attention they place on the process that produces it. Profit becomes the scoreboard, but the scoreboard does not control the game. Sustainable results come from consistent decision-making, structured risk management, and patience in waiting for high-probability opportunities. When the focus remains on outcomes rather than process, the foundation of consistency begins to erode. Consistency in trading is not built through occasional large profits. It is built through repeatable behavior. A well-defined process allows traders to evaluate decisions objectively and refine their approach over time. When the process remains stable, results gradually become more predictable. Without that process, outcomes fluctuate randomly, and long-term profitability becomes difficult to achieve. In this sense, trading success is less about chasing profits and more about protecting discipline. The market rewards structured behavior over long periods of time, but it punishes impulsive reactions. When attention returns to the process, clear rules, confirmed entries, controlled risk, and patience, consistency begins to reappear. And once consistency is established, profitability becomes a natural byproduct rather than the constant source of pressure. In trading, the way results are interpreted often determines how decisions evolve over time. One of the most common mental frameworks that develops early is outcome-oriented thinking. This approach evaluates the quality of a trade almost entirely by its result. If a trade produces profit, it is considered a good decision. If it results in a loss, it is viewed as a mistake. On the surface, this way of thinking appears logical because trading is connected to financial gain. However, the relationship between decisions and outcomes in financial markets is more complex than it first appears. Outcome-oriented thinking creates a cycle where emotions rise and fall with every individual trade. A profitable position can generate excitement, confidence, and sometimes even a sense of validation. The mind interprets the profit as evidence that the decision-making process was correct. On the other hand, a losing trade often produces frustration, disappointment, or doubt. Instead of analyzing whether the trade followed a structured plan, attention shifts entirely toward the financial result. This emotional attachment to individual outcomes gradually builds instability in decision-making. Another consequence of outcome-focused thinking is the development of short-term mental patterns. Each trade begins to feel like a test of skill or intelligence rather than a small part of a long sequence of probabilities. When success is judged trade by trade, patience becomes difficult to maintain. Traders may feel pressure to win quickly after losses or to continue trading aggressively after wins. The mind begins to treat every position as a moment that must deliver immediate validation. In reality, trading performance cannot be accurately measured through a single result or even a small series of trades. Process-oriented thinking offers a different perspective. Instead of evaluating trades based on profit or loss alone, the focus shifts toward how well the trade followed predefined rules. A trade that respects the strategy, follows risk management guidelines, and meets entry criteria is considered a successful execution regardless of the outcome. Likewise, a trade that breaks rules or ignores confirmation signals is considered a mistake, even if it produces profit. This shift in perspective separates decision quality from financial outcome. When attention moves toward execution quality, trading becomes a structured activity rather than an emotional one. The primary objective becomes consistency in following a plan. Each trade is viewed as one data point within a larger statistical sample rather than a defining moment. Over time, this approach allows traders to evaluate their performance objectively. Instead of asking whether a trade made money, the more important question becomes whether the decision matched the strategy that was designed to manage risk and capture opportunities. This mindset also reflects the reality that financial markets operate on probabilities rather than certainty. Every trading strategy is built on the expectation that a particular setup will perform favorably over a large number of occurrences. No individual trade carries a guarantee of success. Even a perfectly executed trade can result in a loss simply because market conditions change unexpectedly or short-term randomness affects price movement. Understanding this principle is essential for maintaining discipline. Markets reward process because outcomes are distributed randomly in the short term. In any sequence of trades, results will appear in unpredictable patterns. A strategy that has a statistical edge might produce several losses in a row before generating a series of gains. Without a process-oriented mindset, these fluctuations can easily lead to emotional reactions. Traders may begin to doubt their strategy during normal periods of variance and abandon it prematurely. Another important aspect of market behavior is that poor decisions can occasionally produce positive results. A trade entered without confirmation or with excessive risk may still generate profit if price movement happens to move in the desired direction. When this occurs, outcome-oriented thinking reinforces the wrong behavior. The mind associates profit with skill, even though the decision itself did not follow a reliable structure. Over time, this reinforcement encourages further deviation from disciplined trading practices. Because of these dynamics, focusing solely on results can gradually damage consistency. When profits decline or losses appear, the natural response is often to chase results. Traders may begin placing more trades in an attempt to recover quickly. This behavior, known as overtrading, increases exposure to random market movements and amplifies emotional pressure. Instead of improving performance, it typically leads to additional instability. Another common reaction to disappointing outcomes is frequent strategy changes. A trading method may be abandoned after a short series of losses, even though the strategy itself remains statistically valid over a larger sample size. Searching constantly for a new system creates a cycle where no approach is tested long enough to demonstrate its true potential. The focus remains on finding immediate results rather than building long-term consistency. Risk management can also deteriorate during periods of emotional decision-making. After losses, the temptation often arises to increase position sizes in order to recover faster. This adjustment introduces greater volatility into the trading account and magnifies the psychological pressure associated with each trade. Decisions become more reactive, and the ability to follow rules weakens further. These patterns reveal an important principle: stability in trading behavior comes from stability in process. When rules remain consistent and execution follows a structured plan, performance becomes easier to evaluate and improve. A clear process acts as a framework that protects decision-making from emotional swings. It allows traders to observe patterns, refine strategies, and maintain discipline even during periods of uncertainty. In contrast, constant attention to outcomes often produces behavioral instability. Emotional reactions to wins and losses create a cycle where decisions are adjusted repeatedly in response to short-term results. This instability prevents the development of consistent habits and makes long-term improvement difficult. Trading becomes unpredictable, not because the market is impossible to understand, but because decision-making changes from moment to moment. The central lesson is that long-term performance depends far more on the stability of the process than on the outcome of any individual trade. Profits and losses are natural components of market participation, but they do not define the quality of decisions in isolation. When the focus remains on disciplined execution, risk control, and adherence to strategy, performance gradually stabilizes over time. In this environment, outcomes begin to reflect the strength of the process rather than the randomness of individual trades. Trading activity is not influenced only by technical knowledge or strategy design. Much of the behavior that appears in the market is driven by psychological mechanisms that operate beneath the surface of conscious decision-making. One of the most common patterns that develops over time is forced trading, a situation where trades are entered not because a clear opportunity exists, but because internal pressure makes inaction feel uncomfortable. Several psychological forces contribute to this behavior, and understanding them is essential for maintaining long-term consistency. One of the strongest drivers of forced trading is the fear of missing opportunities. Financial markets move continuously, and price charts constantly display new fluctuations. For someone actively watching the market, every movement can appear meaningful. When a strong price move occurs, it can create the impression that a profitable opportunity is unfolding in real time. This perception often leads to a sense of urgency. The mind begins to believe that participation is necessary in order to benefit from the movement. As a result, traders may begin monitoring charts more frequently and for longer periods of time. Instead of checking markets at specific intervals, attention becomes constant. Every small shift in price is examined closely, and the mind attempts to interpret each movement as a potential signal. Over time, this habit gradually reduces patience. Waiting for a well-defined setup becomes more difficult because the brain is continuously exposed to new information that seems actionable. The longer someone watches the market, the stronger the urge becomes to participate in at least some of those movements. This dynamic can create the impression that staying out of the market means missing profit. In reality, most price fluctuations do not align with structured trading criteria. However, when attention is fixed on short-term activity, the distinction between meaningful setups and random movement begins to blur. The desire to capture every possible move slowly replaces the discipline required to wait for high probability conditions. Another powerful psychological mechanism emerges after losses occur. Financial drawdowns create emotional discomfort, even when losses remain within planned risk limits. A losing trade can trigger frustration, disappointment, or self-doubt. These emotions generate a natural desire to restore balance quickly. Instead of accepting the loss as part of the statistical nature of trading, the mind often begins searching immediately for another opportunity to recover the lost amount. This reaction leads to an attempt to regain losses as quickly as possible. The logic appears simple: if a previous trade resulted in a loss, another successful trade should repair the situation. However, this reasoning ignores the fact that market opportunities do not appear on demand. When the primary goal becomes recovery rather than disciplined execution, patience decreases significantly. Traders may enter positions earlier than planned or take setups that only partially match their strategy. In many cases, risk exposure also begins to increase during these moments. Position sizes may grow larger in an attempt to accelerate recovery. While this adjustment may seem like a solution in the short term, it actually increases emotional pressure and volatility. Larger positions amplify the psychological impact of price fluctuations, which further weakens decision-making. Instead of restoring stability, the attempt to recover losses quickly often leads to additional inconsistency. A third psychological factor behind forced trading is the illusion of control. Human behavior naturally associates effort with results. In many professions, increased effort leads directly to increased productivity. However, financial markets do not operate under the same principle. Market outcomes are influenced by countless participants and external factors that cannot be controlled by any single individual. Despite this reality, the mind often develops the belief that more effort should produce better results. Traders may begin analyzing charts more intensely, searching for additional indicators, or studying very short-term price movements in the hope that deeper analysis will reveal hidden opportunities. This behavior creates the impression that control over market outcomes can be increased through greater involvement. In practice, this often leads to overanalysis. Small fluctuations in price that would normally be ignored start receiving significant attention. Patterns are interpreted where none truly exist, and random movement may be mistaken for meaningful signals. Instead of improving decision quality, the illusion of control encourages trades that are based on excessive interpretation rather than clear strategy criteria. Continuous engagement with the market also introduces another psychological challenge: emotional decision fatigue. Monitoring charts for long periods requires sustained concentration. Each potential setup requires evaluation, and every trade involves decision-making under uncertainty. Over time, this constant cognitive effort begins to drain mental resources. When mental fatigue increases, clarity of judgment gradually declines. Early in a trading session, decisions may follow structured reasoning and disciplined analysis. After multiple hours of observation or several consecutive trades, the mind becomes less capable of processing information objectively. Small shortcuts begin to appear in decision-making. Confirmation rules may be ignored, risk parameters may be adjusted slightly, and trades may be entered more quickly than planned. Decision fatigue also weakens emotional regulation. When the mind becomes tired, impulses are harder to control. A trader who initially intended to remain patient may suddenly feel the urge to enter a trade simply to break the monotony of waiting. At this stage, trading behavior becomes increasingly reactive rather than strategic. These psychological pressures often accumulate gradually rather than appearing suddenly. Fear of missing opportunities encourages constant monitoring. Losses create the desire for quick recovery. The illusion of control motivates deeper analysis and increased activity. Mental fatigue then reduces the ability to maintain discipline. Together, these forces create an environment where forced trading becomes more likely. The turning point in this cycle often begins with a change in perspective. One of the most important realizations in trading is the distinction between patience and inactivity. Waiting for a valid setup may feel unproductive, especially in an environment where markets move constantly. However, disciplined waiting is not the same as doing nothing. It is an intentional decision to preserve capital and mental clarity until conditions align with the strategy. Understanding this distinction helps reduce the psychological pressure to act. Markets do not provide equal opportunities at every moment. Certain conditions offer clear structures and probabilities, while others remain uncertain or unpredictable. Recognizing this variation allows traders to step back during unfavorable periods without interpreting the pause as failure. Accepting that not every market condition requires action is one of the most important psychological shifts in trading. When this principle becomes clear, participation becomes selective rather than compulsive. Trades are entered because they meet predefined criteria, not because the mind feels compelled to be involved. This shift transforms trading from a reactive activity into a disciplined process guided by patience, structure, and controlled decision-making. In the early stages of trading, the primary objective is often framed around profit. The expectation is simple: identify opportunities, enter trades, and generate financial gain. While profit is the ultimate purpose of trading, focusing directly on profit can create psychological pressure that interferes with disciplined decision-making. Over time, experienced traders often reframe their objective. Instead of concentrating on the immediate outcome of each trade, attention shifts toward the quality of execution. This change transforms trading from a pursuit of quick financial results into a structured process of consistent decision-making. Shifting the objective begins with replacing profit-based goals with execution-based goals. Instead of asking whether a trade produced profit, the more important question becomes whether the trade followed predefined rules. When the focus moves toward executing a strategy correctly, emotional attachment to individual outcomes begins to weaken. A trade that follows the strategy precisely is considered successful from a procedural standpoint, even if the market produces a temporary loss. Likewise, a profitable trade that violates established rules is recognized as a flawed decision despite the positive result. This distinction allows traders to evaluate performance objectively rather than emotionally. Focusing on correct decision-making also creates a framework for long-term improvement. When performance is measured through rule adherence, patterns in behavior become easier to identify. Consistent execution makes it possible to evaluate whether a strategy truly has an edge in the market. If results are inconsistent, adjustments can be made based on data rather than emotional reactions. In contrast, when attention remains fixed on profits alone, it becomes difficult to determine whether success or failure is the result of skill, randomness, or temporary market conditions. A structured trading framework plays an essential role in supporting this mindset. Structure transforms trading from a series of impulsive reactions into a repeatable process. The foundation of such a framework begins with clearly defined entry criteria. Before a trade is considered, specific conditions must be present in the market. These conditions may involve price patterns, confirmation signals, or other analytical factors that align with the strategy. By establishing these requirements in advance, the decision to enter a trade becomes systematic rather than spontaneous. Equally important is the definition of risk before the trade begins. A predetermined stop-loss level establishes the point at which the trade will be exited if the market moves in an unfavorable direction. This boundary protects trading capital and prevents emotional hesitation during moments of uncertainty. Without a defined exit level, Traders may be tempted to hold losing positions longer than intended in the hope that the market will eventually reverse. Clear stop loss placement removes this ambiguity by transforming risk into a controlled parameter. Pre-planned target levels provide the opposite side of the trade structure. While stop losses manage potential loss, target levels establish realistic expectations for potential profit. Defining these levels in advance prevents the common tendency to close trades prematurely during small gains or to hold positions indefinitely while hoping for larger profits. Together, entry criteria, stop-loss placement, and target levels form the structural foundation that guides each trading decision. Risk management rules extend this structure even further. These rules determine how much capital is exposed in any single trade and how overall account risk is controlled. Fixed risk parameters help prevent large fluctuations in account value and protect traders from the consequences of emotional decision-making. By limiting exposure to a small portion of capital on each trade, risk management ensures that no single outcome can significantly damage the trading account. Within this structured framework, patience becomes a critical skill. Markets do not provide equal opportunities at all times. Some periods offer clear trends and strong setups, while others produce erratic or uncertain price movement. Patience allows traders to wait for moments when market conditions align with their strategy. Instead of reacting to every price movement, disciplined traders remain selective. They understand that high-probability opportunities appear intermittently rather than continuously. Avoiding trades during uncertain conditions is an important part of this patience. When markets become unpredictable or when price movement lacks clear direction, entering trades often introduces unnecessary risk. Stepping back during these periods preserves both capital and mental clarity. This restraint can be difficult because inactivity may feel unproductive. However, recognizing that opportunity is unevenly distributed helps reframe this waiting period as a strategic decision rather than a missed chance. Risk management eventually becomes the primary priority within professional trading discipline. While profit is the desired outcome, protecting capital becomes the central responsibility. Without capital preservation, the ability to continue trading disappears. Every trade, therefore, begins with the question of risk rather than reward. Traders evaluate how much can be lost if the trade fails and whether that loss remains acceptable within the overall strategy. Avoiding large drawdowns is a direct result of this mindset. Drawdowns not only reduce financial capital, but also affect psychological stability. Significant losses can trigger emotional reactions such as fear, frustration, or impulsive attempts at recovery. By controlling risk carefully and maintaining consistent position sizes, traders reduce the likelihood of experiencing dramatic fluctuations in account balance. This stability helps maintain clear thinking and disciplined behavior. Psychological stability is one of the most valuable benefits of disciplined risk management. When risk is controlled, traders experience less anxiety during market fluctuations. Individual trades no longer carry overwhelming emotional weight because their potential impact on the account remains limited. This calm environment supports better decision-making and reinforces the structured approach that long-term trading requires. As discipline and structure become central to trading behavior, the overall experience of trading begins to change. The excitement that often characterizes early trading gradually gives way to consistency. Instead of chasing dramatic gains or reacting to sudden market movements, traders begin to focus on maintaining steady performance over time. The goal shifts from occasional large profits to stable growth built through repeated, disciplined execution. Stable performance curves reflect this transformation. Rather than experiencing large swings between gains and losses, the account begins to move with greater predictability. Progress may appear slower compared to the dramatic expectations often associated with trading, but it is also far more sustainable. Consistency replaces volatility, and confidence develops through adherence to process rather than dependence on lucky outcomes. Reduced emotional volatility is another natural consequence of this disciplined approach. When trades follow a clear structure and risk remains controlled, the emotional highs and lows associated with trading become less intense. Wins are viewed as expected results within a probability-based system, and losses are accepted as normal occurrences rather than personal failures. This balanced perspective helps maintain focus and prevents emotional reactions from interfering with strategy execution. Ultimately, the shift toward professional discipline reframes the entire goal of trading. Profit remains the long-term objective, but it is no longer pursued directly through impulsive action or constant market participation. Instead, profitability emerges as a byproduct of structured decision-making, careful risk management, and consistent execution. Over time, this disciplined framework supports sustainable performance and transforms trading from a reactive activity into a controlled, professional process. Building a process-focused trading mindset begins with redefining what success truly means. In the early stages of trading, success is usually measured by profit. A winning trade feels like proof of skill, while a losing trade often feels like failure. However, financial markets do not operate in a way that guarantees consistent short-term outcomes. Because of this, measuring success purely by profit can create emotional instability. A more sustainable approach measures success by discipline and adherence to a structured process. When success is defined by discipline, the quality of decision-making becomes more important than the outcome of any individual trade. A trade that follows predefined rules, such as clear entry criteria, proper risk management, and planned exits, can be considered a successful decision even if it results in a loss. At the same time, a profitable trade that ignores those rules represents poor execution. This perspective helps separate decision quality from financial outcomes and encourages consistent behavior over time. Another important element of a process-focused mindset is separating personal identity from trade results. When confidence becomes tied to winning or losing trades, emotions begin to influence decision-making. A loss may feel like a personal mistake, while a win may create overconfidence. By treating trades as neutral events within a probability-based system, traders can maintain emotional balance. This emotional separation makes it easier to stay disciplined regardless of short-term results. Developing a structured routine also plays a key role in supporting this mindset. Consistency in daily habits creates consistency in trading behavior. The routine often begins with pre-market preparation, where market conditions are reviewed and potential setups are identified. This preparation helps traders approach the market with a clear plan rather than reacting impulsively to price movements. Having a defined trading plan for the day further strengthens discipline. The plan outlines what types of setups will be considered, how much risk will be taken, and when trading activity should stop. With these guidelines established in advance, decisions during live market conditions become more controlled and less emotional. Post-trade analysis is another important part of the routine. Reviewing trades after the session allows traders to evaluate whether their decisions followed the strategy. Many traders use a journal to record the reasoning behind each trade, the conditions present in the market, and whether the rules were followed. Over time, this information provides valuable insights into patterns of behavior and areas that need improvement. A process-focused mindset also requires accepting the uncertainty that exists in financial markets. No strategy can guarantee that every trade will succeed. Losses are a natural part of probability and should be expected even when decisions are correct. Understanding this principle helps reduce the pressure to control outcomes. Instead of trying to force profits, disciplined traders focus on what they can control: preparation, risk management, and execution. Each trade is viewed as one event within a long sequence of probabilities rather than a defining moment. This neutral perspective prevents emotional reactions and encourages patience. In the long run, profit becomes a byproduct of correct execution rather than the immediate goal. Markets tend to reward disciplined behavior more than strong desire for quick results. When traders focus on following their process consistently, performance gradually stabilizes. Over time, a consistent process leads to consistent results, creating a more sustainable path in trading.